Hello, everybody. Welcome to Clef Investments. In today's session, let's do a little deeper dive to the collar strategy. If you already have a stock portfolio, you can make it into a collar by out of the money put, protects the downside risk, and sell out of the money call so that you can get some money to pay for the put. And the profit loss looks like the picture on the right, where once it reach the put strike, you no longer have more losses. And if the stock price increase to the strike of the call, you no longer get any more profit. Collar strategy give you less volatility in your stock portfolio, but also in the long run, you have less return because the call would limit your return. So it has a trade-off. And also, it's likely to generate more tax if you make some money in your put or your call. When would collar be a good strategy for you to consider? I think if you need money in midterm, like a few years, and you don't have enough money to tolerate the up and down of the market. So for example, if you are young and you are saving money to buy your first house, you don't want this money to go down a lot if you get into a bear stock market. Or if you're retired and you need to use this money in the next few years, and you don't have enough money for you to take the risk, then this could be considered. And if you need the money in very short term, maybe you just go and buy treasury bill or note and take a risk-free return. You have zero risk to lose your money. With collar, you still have some risk to lose some portion of your money. And if you don't need that money in the short term or midterm, you can make a long-term investment where you just buy and hold stock index such as S&P 500 or Nasdaq 100. So personally, I'm not using the collar strategy, but this is based on the risk and reward. That's the recommendation I can give. The collar, when you implement it, there are several parameters that you need to consider. So first, the call and the put, you need to pick the strike distance. And there's a trade-off there. If you pick the strike distance very close to the current stock price, then the volatility of your portfolio would be very low. You won't lose much money and you won't make much money. Or you could pick a wider distance. You allow the stock to go high by quite some distance to get more profit. But because the very out of money call is very cheap, you won't sell it for much money. That means you don't have enough money to buy expensive put. So your put strike would be lower, which give you higher risk. So this is the trade-off you need to pick depending on your risk tolerance. And I would say pick a distance that it has a maximum risk you can tolerate so that it allows you to pick the highest call strike to maximize your potential gain. Another parameter of collar is the expiration time. You could use 1 month or 6 months or 1 year. If the expiration is shorter, then it is in general more expensive. So for example, yesterday's S&P 500 close price for SPY is 553. And if I pick an out money put, that's 12% out of money with a strike price 485 and also a year to expire, then the price of the put is 45 cents. If you pick a expiration date to be 1 month from that day, and you assume it would drop 1% because comparing to 12% drop in a year, it's roughly 1% drop in a month. But then the price of the put is more than 10 times of the 1 year. So this is something you need to consider. And if you pick a shorter expiration, it gives you more chances to do frequent adjustment because every month you need to adjust. But for me, because I cannot predict market direction. So I feel better to use a longer expiration time. Just let it run. Let the stock and color run. And I wouldn't try to outsmart. And also, use less adjustment means you don't need to spend too much time to look at your portfolio. And you spend less commission and slippage. If you need your money in a few years, I don't think it's very useful to look at it very often. It could be stressful if the stock goes the other direction. And also, if the stock drops and if you make some money in your put, you could use that put to buy more stocks, which allow you to increase your portfolio. And effectively, you are buying stocks at a lower price, which is good thing. And by looking at the profit loss graph, color is very similar, actually identical to a very popular strategy called vertical spread. The color is similar to a bull vertical spread. There are two kinds of bull vertical spreads, the bull put spread or bull call spread. So for the bull call spread, you buy the lower strike call and sell the high strike call. And it'll take some money out of your account. For the put spread, you get credit because you still buy the low strike put, but you sell the more expensive high strike put. So you get some cash into your account. So both would have identical profit loss graph. You can pick the one that you feel comfortable. So if you get credit, you may get some interest depending on your broker. Of course, you need to pay tax on the interest. I don't like tax. So maybe I would just choose the bull call spread if I want to use it to replace the collar. And also vertical spread, because it doesn't buy stock, it has a bigger leverage compared to collar. So this is something important we need to remember. Bigger leverage means double-edged sword. You could hurt yourself or you could get a bigger portfolio than what you can do with collar. And the bigger leverage is not free lunch. The interest rate is already priced into the option you are buying. You are not getting some free money. This is some basic knowledge about collar and when you can use it. Next time, let's talk about ETF called buffered ETF, which has some similarity to collar and vertical spread. That's all for today. Thank you.